Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So, hey, folks, welcome back to Accelerated Investor. Hey, I'm your host, Josh Cantwell. And today I've invited my good friend and a longtime contributor to the podcast back onto the show. His name is Daren Blomquist. He's the VP of Market Economics at auction.com. We try to have him on the show at least once a quarter to talk about not only the general higher level indicators of the overall economy, but we also like to then dig into specifically real estate distress, real estate default, because those are the types of assets that you can buy on auction.com. So Daren and I are going to talk today primarily about the more larger macroeconomics and some of the changes that we've seen over the last quarter, last year, last couple years, and how this is hopefully going to help us understand what's going to be happening over the next couple of years and how that's going to impact real estate. So I want to welcome Daren Blomquist back to the show. Daren, thanks so much for joining us.
Thanks, Josh. Good to be here as always.
Absolutely. So guys, as always, Daren's got some great slides to share. If you catch this in a more of an audio podcast format, you're not going to be able to see the slides, but you'll be able to get great audio information from Daren and I. If you want to see the video portion, make sure you go to YouTube to watch this, because then you'll be able to see the slides that corresponds to the conversation. And so, Daren, obviously a couple of years ago, we were never talking about recession. We were never talking about things going down. It was always about things going up, 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 values going up, up, up. And then, of course, we had a lot of conversations around COVID. Today, a lot of people are just continuing to talk about the recession indicators. Last night was the State of the Union address. President Biden spoke about a number of different things. The Federal Reserve just raised interest rates another 0.25% about a week ago. And they're starting to talk about tapering off some of the rate increases. And they're becoming a little bit more bullish about a soft landing. But I'm absolutely very curious to hear about some of the things that you're seeing in the marketplace. So let's talk about some of the recession indicators and some of the indicators that you track. What are some of the major ones that you're seeing right now that you're tracking, and the ones that are moving the most?
Yeah, so we look at the ones we have here on the slide: yield curve, manufacturing index, consumer sentiment, unemployment rate. We throw in foreclosure starts. That's not really a traditional recession indicator, but for our line of business, that is one that we look at carefully. But, we kind of just have a simple presentation here where it's either red, yellow, or green, each of these indicators. And red means more of a recession is likely. Yellow is kind of middle of the road, and green is not a recession. It's not indicating a recession. So yield curve is definitely indicating a recession. And I have a slide, we can dig into that. I think that is historically the most reliable indicator of a recession. And, it's now indicating a very high percentage likelihood of recession about a year from now in late 2023. So that's red. Manufacturing index is below 50, at least it has been. It was in November when I pulled these numbers. And so that's kind of right in the middle. Anything below 50 means a contracting market, and that's historically been a pretty good indicator of recession. Consumer sentiment is also red because that has been coming down, and we look at the University of Michigan Consumer Survey for that. Unemployment rate is the one that's extremely strong in the green, and and the numbers just last week I think came out for January, even lower than what I have here, and the unemployment rate at 3.4%. Over 500,000 jobs added in January. That is the area where it seems to be bucking the trends and bucking expectations of what most economists believe. Now, my argument there is that, that's actually not to look for the dark cloud behind the silver lining, but that's actually kind of bad news for the recession, because that, to me, is going to put more pressure on the Fed to continue raising rates to tame inflation. And that low unemployment rate, of course, we always want to say employment is good, but if you have underemployment, too low employment rate, that's putting upward pressure on wages, which is then impacting inflation. And so that will put pressure on the Fed to continue for a longer term, even though they may pull down the rate of increase of their rates. I think this is an indication that they will continue to raise rates for a longer period of time, which then increases the likelihood of recession in the long run. But in the short run, unemployment is going gangbusters.
I agree with that. I know the Fed had talked about unemployment going to at least 4.4, 4.5, somewhere in the middle fours to upper fours. And that stayed down. I mean, right now, actually, with all the jobs that we just added, was 3.4, was at a 53-year low. And Janet Yellen, who right now is in this current administration, used to, be very involved in the Federal Reserve. She said, look, if unemployment is this low, you don't have a recession, which I agree. We don't have a recession right now, but a year from now, right, with rates keeping going up in order to tame inflation, it's almost inevitable. It has to happen. And again, recessions are not a bad thing. Recessions are cyclical. The economy is cyclical. They need to happen. That needs to tame the growth in order to set up the next growth phase. And so hopefully the Federal Reserve allows that to happen. I would be actually happy to see a recession actually take place. There was a lot of indicators around, the last 2 quarters where GDP had gone down, but then it popped back up. And people say, well, you can't have a recession if unemployment is below 4%. But we're all talking about not being in a recession today, but, in later this year, maybe Q4 or in 2024, early 2024, that happening. And I absolutely see that happening. And I'm actually looking forward to it. How about foreclosure starts, Daren? Obviously, we've tracked foreclosures for years. We had the foreclosure moratorium during COVID. Things are starting to normalize out. How is that an indicator, and what's happening with foreclosure starts?
Yeah, we put foreclosure starts as a red indicator because, and it is more of a return to normal. It's not that foreclosure starts are hitting concerning levels in context of, say, 2009, 2008 levels, but we are seeing big increases in foreclosure starts as the moratoriums lifted at the end of 2021. So 2022, we saw, if you look at the whole year, we saw 169% increase in foreclosure starts in 22 versus 21. That's expected because the 21 levels were so low, but that does mean there's more distressed property supply coming to the market. And we expect to see some of that hit our foreclosure auctions in 2023, some of that increase. Now there's tons of effort continuing to be put on making sure that unnecessary foreclosures are prevented, which is good. So I'm not expecting 169% increase in foreclosure auctions in 23 that parallel that increase in foreclosure starts, but we're calling for actually conservatively about 24% increase. Anyway, that to me, it's actually a healthy thing to release some of this inventory that's just been held back by the moratorium. And it's actually healthy for the housing market, some of that distressed inventory getting into the market so it can get to what we call local community developers, local investors who can rehab that inventory, get it back into the retail market and put it to good use. So it's actually helping the housing supply issue. But in the short term, it may mean it's going to put some downward pressure on home prices.
Got it. And how about long range forecasts? Home price appreciation is starting to slow down. I still can't believe when I see this statistic about the average days delinquent. I remember back in the day when if you were 90 days delinquent, the bank would start the foreclosure process. And now you see this average days delinquent is pushing up to 600 days, almost a year and 3/4 because of COVID and because of a lot of the foreclosure moratoriums. But tell us a little bit about these gauges and what story do they tell?
Yeah, and the long range forecast here is in the context really of the distressed market for auction.com, what we're looking at. So home price appreciation is a big one, and that has been coming down as of December. It was in the low, according to NAR and Atom Data Solutions. We look at both of those in the low single digits. Home price appreciation nationwide. Some markets are starting to see negative home price appreciation. Places like the west coast of California, or the coastal markets, and so that is that's a signal that the housing market is going through what I agree with you, what would be a healthy correction if we see home prices correct a bit, and what some others are predicting of anywhere from a 10% correction in some markets to much more in other markets. The seriously delinquent rate is also something we look at. That is still going down and looking good. There are some indications, and maybe this is a topic for a future podcast. We can dig into those delinquency numbers. There's indications now, though, that early stage delinquencies are starting to rise. And so that's presenting another issue down the road. But for now, the seriously delinquent numbers have been tamed. They spiked during the pandemic, but I would say they've been tamed. One thing that the housing market has going for it in terms of the distressed market is real estate net worth, which is basically home equity. Many people have a lot of home equity in their homes. Now, home price appreciation could change that, but that will also help prevent a lot of foreclosures. The biggest headwind for the market that could lead to more distress is the rates going up. The 30-year fixed mortgage rate, that has flattened out a little bit and even come down in recent weeks, but it's still about twice the level it was a year ago even. So that kind of increase is unprecedented. And I do think it's going to have some kind of impact, or it already is having a dramatic impact on the housing market. And as we get into the 2023 spring selling and buying season, especially, I think you're going to continue to see that have an impact on dampening demand and pushing sellers to become a little bit more realistic on their prices. And then finally, you mentioned the average days delinquent. It's just crazy at, over basically 575 days, average days delinquent. That tells us, and that has gone up quite a bit during the pandemic, it tells us there is a lot of this distress that was deferred during the pandemic that's very aged, and it's the longer that goes delinquent, the less likely it is that person's going to avoid foreclosure. So we think that's an indication that some of that backlog from the pandemic is going to be hitting 2023, 2024. Yeah.
And the 30-year mortgage is a headwind. I agree with that a lot in that, look at this a year ago. Good God, 3% on a 30-year fixed rate mortgage a year ago. The Fed started raising rates in March of 2022, and then they raised them at an unprecedented speed. And so because there's still a significant lack of inventory, there's still demand for houses, but I think buyers have a much more realistic, if you will, or much more tempered expectation of what they're willing to pay. Because if you double your mortgage rate, it's a high likelihood you're about doubling your payment. You may not double the taxes or the insurance costs, but the actual payment on the mortgage is going up substantially. And with that being said, buyers still want properties, buyers still want inventory, buyers still want to buy, but a seller might put a property on the market for $700,000, and in the past would get multiple offers over $700,000. Now they might put the property on the market for $650,000 and get offers for $600,000. You know what I mean? So there's a major difference there in the price expectations of buyers. and buyers are just simply going to write lower offers because their cost of debt is higher. And also their sentiment as far as growth and appreciation in the market is not this frenzied expectation of future upside. And so if that upside is tempered, they're going to want to be more conservative in their offers, and sellers are going to have to adjust to that. That's what I think is coming in the spring selling season, in my opinion.
Yeah. And we see that on our platform. I think our platform is a great microcosm and even forward-looking microcosm of what's going to happen in the retail market. Our buyers became, and we're a bidding environment, auction.com. And so you can kind of see that real-time standoff between sellers and buyers happening.
Yeah.
And what we saw is buyers pulled back dramatically starting around March of 2022, when interest rates went up and became extremely more conservative. But finally, and sellers didn't adjust for a while, but finally in the fourth quarter of 2022, we started seeing sellers saying, okay, we give in, we're going to lower pricing a little bit. And the buyer demand already in January, we're seeing as a result of that lower pricing is starting to come back. Mm-hmm. So it's really interesting kind of to see that play out on our platform. And I think probably want to be exactly the same in the retail market, but I think we'll see a similar pattern here in the next few months.
We're seeing the similar pattern even with commercial. A real world example is back in the fourth quarter of 2022, there was a building that we were offering on, and the seller was expecting multiple offers, multiple bidders. That's what happened. This actually happened in the third quarter. We were actually awarded the deal at $12 million. And in the 48 hours after we were awarded this $12 million asset, this apartment building, we ran back through all of our underwriting, and we ran back through the cost of debt. And not only did we decide to not only lower our offer, we decided to completely tap out, and we didn't want the asset at any price. We just decided to tap out. And also there were two other buyers that were hot on our heels for the same asset. They decided to tap out and move on to either other assets or not buy either. And now that asset is basically kind of quietly listed, quietly for sale. And the expectation on that price is down by $1 million. And that's changed in just the last 3 to 4 months, where buyers are much more nimble than sellers, because buyers can change their mind immediately. Seller is more married to what did they see everybody else getting 3 months ago, 6 months ago. They have a certain expectation that they get married to. And if they can't get that, especially with all the equity that we've seen for both residential and commercial real estate, with all the appreciation, they're just not forced to sell because they have cash flow and they have a lot of equity. So they just simply don't sell the asset. They're going to wait it out. This particular seller still wants to sell the asset because he lives out of the area, wants to get his equity out, has a tremendous amount of equity, has a very low basis. So he's willing to sell, and he's come off of his asking price by $1 million. And so that's an interesting phenomenon. So we're looking at that asset again. It doesn't mean that we'll even buy it at this new price, because the cost of debt is so much more expensive. The debt service coverage ratios are still problematic. And so that's a real world example in the commercial space.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast.
Daren, tell us in this next slide a little bit about this rising recession risk when we look at the inverted treasury yield, that inversion happening, consumer sentiment changing, and the probability of an upcoming recession. Obviously, looking at this chart, the red line's going up. So it looks like the risk of that is increasing all the time.
Yeah, and this is data from the Federal Reserve Bank of New York, which creates a derivative off of the yield curve that predicts the likelihood of recession in the next 12 months. So they're saying a 38% chance of a recession in November 2023. That may not sound bad, but that's the highest likelihood percentage of a recession since March 2008. And we know what happened right around March 2008. We were in a recession. So this to me is the most reliable indicator going back historically. This chart goes all the way back to 1959. And you can see that the probability of recession, which is the red line you refer to, spikes right around when the recessions actually happen. And keep in mind, this is it's predicting it 12 months in advance. And so it's a great way to see what's have a little bit of a crystal ball. I mean, there's always a possibility that we could somehow avoid a recession, but it seems extremely likely at this point, based on these numbers. And then, at least in the next 12 months, late 2023 being the time frame here.
Mm-hmm.
So yeah, that's a deeper dive there. The next slide, by the way, it really gets into a lot of what you've been talking about with the affordability and the cost of debt, really putting a damper on demand in the market.
Mm-hmm. If the home price appreciation fell to 3.5% back in November, as we record this is the first week of February 2023. I would be curious if we're kind of flat now, or if even negative to a small degree.
Yeah, actually the December numbers have come out, and we're at the NAR puts us at 2.3% appreciation in December. So barely, very low single digits. And we use our buyer bidding behavior on our auction.com to predict home prices, actually, and it's a pretty good predictor, at least about 2 months in advance. And those buyers are predicting that prices would go negative in January nationwide. Now, what's interesting is, though, we have seen a little bit, because sellers have adjusted prices, we have seen that resurgence in demand from our buyers. And if we see that same pattern in the housing market, this could be a pretty quick bottom. I'm just not sure if sellers in the retail market will behave quite as flexibly as the distressed sellers who are less emotionally tied to the properties.
Mm-hmm. Mm-hmm. Yeah, I mean, if by the time we're done recording and then the data comes out for February, which will come out, around March, it's going to be negative is my prediction. And in those boom bust markets, you're going to see a lot of correction. I think that my prediction, I don't have a crystal ball, but you look at places like Austin, Texas, and Phoenix, Arizona, parts of Florida, San Diego, San Jose, those types of markets. Mm-hmm. I just don't see how they could not come down significantly. Significantly meaning a 5 or 10% would be huge. That would be a big number. We're not talking about 30% decline, but over the next couple of years, real estate tends to lag. As we all know, the stock market can drop very quickly. Back in 2007, 2008, the stock market dropped by 50% in 6 months. It took the real estate market all the way until about 2012 to really hit the bottom. Like there was a 33% correction before it started going back up. So real estate is always much slower than the stock market. And so this is going to take all of 2024, 2025 until we see the bottom and see what happens with that. But the fact that we're starting to see some indicators that this is either flat or possibly going negative here in January, February, March, I think is telling a big story. And I think those gateway markets like a Los Angeles, like a Chicago, like a Phoenix, like an Austin, those are going to see more dramatic declines because of just the run up was so big and so fast in 2020 and 2021 when the cost of money was so cheap. It's just got to revert the other way to some degree.
Yeah. And I think, what we're showing here is for a while there, it felt like affordability didn't matter. Like people just pay whatever. But affordability does matter in the market. And I think what we show here is the payment to income ratio for a median priced home in the United States. It seems like the ceiling, we finally found that ceiling at about 34% payment to income ratio. And when we hit that, and we can round it up to 35%, but that seems to be the ceiling. And when we hit that, that's when we saw home prices start to come back down on at least on a month-to-month basis. Now down over 10% from the June 2022 peak. So yeah, affordability matters. And if those interest rates, mortgage rates stay high and the cost of debt stays relatively high, and that's not moving, then I think you don't see incomes moving. I mean, you do see incomes moving, but not as quickly as home prices. That the only thing left to move in that equation is the home prices. And so I think that's where this pressure is coming from. And I don't know if you want to be put in the same sentence as Zillow forecasters, but the next slide looks at what Zillow is forecasting for home prices. And this really stood out to me, just because more about direction than necessarily the specific numbers, but they forecast about 800 markets nationwide, over 800 metro areas nationwide a year in advance. And in September and October, they were forecasting that about a third of those markets would see home price declines in 2023. But then in November, this really stood out to me, that doubled. They went from about a third of markets they were forecasting a decline into 75% of markets now that they're forecasting a decline by November 2023. And so, certainly you see some of those markets that you mentioned, the darker red in coastal California and parts of other parts of the West that have seen big run-ups. And it's 75% of markets, so most of the country you're seeing red in here, but the darker red does tend to be in really, if focusing coastal California. There is some in Texas as well, has seen a big run-up. One of the biggest pockets of green is really still in Florida and other parts of the Southeast.
Mm-hmm. Wow. That's really wild to see. It'll be really wild to see when we have you back on again in 3 months from now, 6 months from now, if the whole thing's not red. But to see it jump from 37% to 75% and double, since October and September into November is pretty wild. Just backing up.
And actually, I should add, Goldman Sachs came out with their forecast, metro forecast, and they're forecasting. And this was a little bit more recent in January. They're forecasting about 95% of markets will see a decline. So they're even more bearish on things. Now, I mean, there's been some good news come out just in the last few weeks, and that could indicate maybe things aren't going to be quite as, maybe there's this chance of a soft landing out there. But I still think the most likely path that we're going to see is some correction. It may not be this huge correction. I would call it a healthy correction that we see happening and in this data. Yep.
That's fantastic. Just going back one slide, looking at this, again, prices responding to affordability. It's amazing to see, when COVID hit in March of 2020, the drop in home price appreciation, the drop in the speed, it was still up, but it was only up about 2%. And then it just absolutely takes off. Why? Yeah. Because the Fed funds rate went to zero and stayed at zero. And also because of COVID, very few people were selling their homes. So inventory was at an all-time low. So you have, cost of money at an all-time low. You have the number of homes available to buy at an all-time low. Maybe not all time, but as far as back as I could remember. And so that forced prices up.
I would add, the third piece of that is you had people getting stimulus checks, and so income going up. And so that helped as well.
Yeah, it would be interesting to see that slide with somehow the Fed funds rate overlaid over top of it and showing as the appreciation goes up in the green, it directly corresponding to the Fed funds rate dropping to zero and staying at zero. And then now as the Fed funds rate has gone up and you're seeing, which basically started in March of 2022, and that goes up, it's amazing to see these statistics here where the home price appreciation starts to crater and go down starting in March of 2022 and really drop off. And then of course that payment to income ratio skyrockets because the cost of the debt's going up. And now you see, again, like you mentioned, kind of a threshold where the payment to income has hit a ceiling where now it's starting to go down and people just can't afford to pay any more. And with that, home prices have to pull back. And that's also at this point interesting to see where the Fed has now said we can do smaller rate increases, maybe not as frequently as rate increases, maybe 25 bips here, 25 bips there, because they're starting to see some of this deceleration of inflation. And it's just so wild to notice that all of that is predicated on the cost of money. That the Federal Reserve really does have so much demonstrative control over the economy by how much money they put in play, how much stimulus there is, and the cost of that money. If the cost of that money is more expensive, it definitely tapers things down. And as the cost of stimulus checks out there, $7 trillion being printed, and the cost of that the mortgage money being so low, it's amazing to see how that directly correlated to values going up. And then now as the Fed funds rate has gone up, directly correlating to seeing those home price appreciation values come down. It's amazing to see how much power the Fed really has.
Yeah.
That's my take.
I mean, it's really it's a perfect case study for, macroeconomics actually working the way that macroeconomics is supposed to work. So,
right.
Yeah.
Amazing stuff. So we'll track that. And then I think this is our last slide, maybe one or two more slides for today, but, indicating just that, for a long time, consumers had gone into saving mode, save, probably because they were panicking about what was going to happen to the world economy. And now that the stimulus checks have worn off and people felt good about the economy for the last year, now they're starting to tap back into their credit card debt. So let's talk for a second just about consumers and how they're behaving and their comfortability with dipping back into their credit cards.
Yeah, so this is just data from the Federal Reserve Bank of New York, again, looking at its household debt. And specifically, if you look at credit card debt, it hit $930 billion in the third quarter of 2022. That's basically an all-time high, equally an all-time high we saw back in Q4 2019, right before the pandemic. And so, yeah, you saw during the pandemic, people stopped using their credit cards as much. I think they had, because of the stimulus, they didn't have to actually dip into savings, because there's another chart that I don't have in this deck that shows the savings rate going up during the pandemic as well. So they were saving more and having to use their credit cards less because in part because of the stimulus, in part because they pulled back on spending. But now we're really seeing that revert back to the pre-pandemic norm. So we're basically going back to 2019 levels with credit card debt, and the 15% increase that we saw in the third quarter was the biggest year-over-year increase we've seen in this data set, going all the way back to a couple decades. So this isn't necessarily a huge warning flag for me, but it's just saying that yes, people are reverting to their kind of pre-pandemic consumer habits, which is relying more heavily on debt than they did during the pandemic. The savings rate also, which again I don't have here, but the savings rate is kind of a mirror image of this, where it spiked during the pandemic, but now it's reverted to actually below. That is a little bit more concerning. Savings rate has reverted to below pre-pandemic levels, so people are saving less than they were back in 2019, which puts them more at risk if there is some kind of shock.
Yeah, And I would venture just a psychological prediction is that many people, especially if they're living paycheck to paycheck, they get used to the stimulus dollars and used to a new kind of lifestyle and used to affording some new things that they previously couldn't. And then all of a sudden the stimulus dollars are no longer there, but they're used to this new sort of lifestyle with the extra thousands and thousands of dollars they were given. And they're like, well, I really enjoyed that. So now I'm gonna have to dip into my credit cards to afford that same lifestyle. That's a guess of mine, just based on, consumer behavior.
I think that's absolutely spot on. Yeah.
Thank you. But yeah, I get used to certain things, right? I buy something new and I'm used to it. I want it. I want to keep it. And if I don't have the income for it, you have to make that decision. Do you cut back or do you use credit? And I think that's what we're seeing right now. Daren, do we want to go any further today, or do we want to save the rest for delinquencies, the real estate, save that for another discussion, right?
Yeah, I think this is a good stopping place because the rest of it really does get into then all of this that we've talked about at a macro level. How is that impacting the housing market and specifically distress in the housing market? So this is a great stopping point.
Go tell our audience just a little bit more about where they can get more economic news from you, where they can go on the auction.com platform to buy properties, and just learn a little bit more about what all the services that auction.com can provide.
Yes, absolutely. For a lot of the stuff I'm presenting here, you can go to auction.com/in-the-news or follow me on LinkedIn or Twitter. I try to post a lot of this stuff as I get it. And then for auction.com, if you just go to auction.com, if you're interested in looking at what types of distressed assets are actually available right now to purchase, just go to auction.com and search. And you'll find that we have both the foreclosure auctions, properties that are sold in the courthouse steps typically, although we've moved a lot of those online. And then we also have the bank-owned or REO auctions, which are all online and you can bid on from anywhere in the country. And it's a great great way to buy low in this market and add value through renovation. Many of these properties are distressed, not just financially, but physically as well.
Yeah, awesome stuff, Daren. Listen, I always appreciate your insight, all the work you do to gather up all this data. I know it takes a lot of time and attention to put this all together. So thanks for aggregating it all for us and for our audience. And thanks for jumping on the show today.
Yes, Josh, thank you for that. And thanks for the opportunity to talk to you and your audience.
So, hey guys, listen, I hope you enjoyed that show today with Daren Blomquist, again, VP of Market Economics at auction.com. Check out auction.com/in-the-news. You can also follow Daren on LinkedIn, as he mentioned. Daren's been a friend of mine for going on, I think, 8 years. He basically is the economist for auction.com, and is an amazing resource. If you paid attention now to the last couple of days, couple of weeks, we've released a lot of data, including the interview with Harry Dent, this interview with Daren, to talk about the overall economy. And I think it's important that we start to make smart financial decisions to prepare for this. One thing I do love about what we do with apartments is that they are very recession proof. As long as you have the cash flow and the occupancy in the apartments to pay the debt service, the expenses, your investors, and just hold them through the trough. That it's a great place to be in versus being in fix and flips or being in wholesaling. And when the market's on its way down, like there's no way to compensate for that when the market's going down. It's not like you can short the market. And so I think it's really important that every investor get liquid, get into cash flowing real estate, whether it's single family or apartments, buy some of those assets or invest as a limited partner, and then get your cash flow for the next couple of years. Because I do see some trouble brewing that's really hard not to see, right? You can't turn a blind eye to this stuff, especially after what you heard from Harry Dent and Daren today. So if you're interested in investing in a limited partner basis or learning more about what we do, go to freelandventures.com/passive. There you can check out and we can get to know each other better. You can learn more about some of the things that we offer. You can learn more about, inside of our investor portal, build a relationship with us, and then go from there. So look forward to having that discussion with you. If you enjoyed this episode, as always, subscribe, rate, and review. Thank you for being here. and we'll see you next time.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.